Hi guys, good morning. We start in about 1 minute, all right? Get ready. So guys, wonderful good morning. Let's do something. Get ready. Hello guys, good morning. Can you all hear me well? Yeah, everyone can hear me? Super. All right guys, let's do something. So I already saw a question in the Zoom chat. Why chapter 15? I thought we have to do chapter 13. No, so please read the course manual. In the course manual, we state exactly which chapters are basically for you to just read, that we don't address in class, simply because I only talk about chapters in class where I can add value. There's nothing to not understand in chapter 13. At the end of the course, should we have some time, and very likely we will, I'm happy to, of course, go through it, address questions, that's not the problem. But primarily, I don't see an easy way for me to add value as compared to you reading this. So there's no point. It's not fairy tale class where I read to you something that you can easily read by yourself. So on the agenda today, really new content, we hop into capital structure. I want to briefly give a little bit of background that you know a little bit what to expect. So this is not very easy to teach. Not at all because it's complicated for students to understand. That's not a problem at all. You will see it's not exactly rocket science. But I think what students sometimes struggle with is why we talk about this. So before we dive into the actual content, it's relevant to understand what exactly it's gonna be that I will be talking about. So we will address capital structure. And let me sketch this out quickly. So you remember that hopefully, we have a balance sheet of some sort of firm. We have assets, liabilities, and owner's equity. We have here all our assets. We have here some degree, some amount of liabilities, and some amount of equity. And ideally, both sides match. So we've already established that companies try to maximize their value. That also allows me, brief sidebar, to address a question I saw that popped up in your workshop on Friday, which was when you looked at the weights, when you calculated the WACC, you remember that I showed you the weight of debt is calculated as debt divided by debt plus equity. And the weight of equity was calculated as equity divided by debt plus equity. However, then in the workshop, I saw quite a few of you struggle with what Celine did. Even though Celine did exactly the same thing as me, she presented it slightly differently, and you need to understand both. So what Celine actually wrote down was this: debt divided by TV and equity divided by TV. So what's that about? Like I said, this is just a brief sidebar. This here is of course short for total value. And what is the total value of the firm? Well, the value it has for your creditors plus the value it has for your shareholders. So TV is simply another way to write debt plus equity. It's exactly the same thing. There's no need to be weirded out by this. Okay? So we have addressed what a company is trying to do. The primary objective of a firm is to maximize firm value. So this here. How can they do this? Well, they need to address two big questions. In which assets should we invest? And how should we finance those assets? So this year we've addressed how can we answer the question in which assets should we invest. If you want to read up on this, the chapter would be investment decision criteria. In the real world, I would say the standard procedure here is a net present value calculation. Okay, so that is this. That is first year finance. We have done a recap on this. I have nothing more to add for now. What we will do in our corporate finance course, we will address the second question. How should a firm finance all the assets? And when I say how should they finance it, what I really mean is what debt to equity mix should the firm go for? So how much debt should the firm have in its capital structure? So that is what's gonna basically inform our conversation. Now, why is this very difficult for students? Or not very, it's kind of difficult. Why is this difficult? Not because of the math involved or the intellectual fundament, not at all. What I think causes trouble here for students is our approach to it. So it would be actually very, very easy. I could in 2 sentences tell you sort of the punchline of today's lecture. 2 sentences, it's really not more. So what is the rest of today's lecture gonna be about? How to get to those 2 sentences, how to get to basically our final conclusion. So we could really cut it short. I tell you the final conclusion today and we're done in 5 minutes. But don't forget we are a university and you're students. So you're not my disciples. You're not in a position where you should believe what I tell you. I should basically persuade you. I should convince you with arguments that our conclusions are applicable, that our conclusions are correct. So 99%, literally 99% of today's lecture is gonna be building up to our conclusions so that the conclusions actually not just make sense for you, but that they are believable. And I'm almost done with the introduction. The big challenge for students seems to be this. This is a very complex question. So this is not trivial. Just already to answer in which assets should we invest is in the real world very, very difficult. And I showed you why. We do not know the future cash flows. We do not really know the discount rate. Even if when we apply the capital asset pricing model, which beta should we use, calculated over which period? So the input in our net present value calculation is already, you know, a guesstimate at best. So if we were to approach the question, how should we finance all our assets? How much debt and equity should we have in our capital structure? If we were to approach this from a real life perspective right away, you would not be able to grasp that. Not because you're stupid or lazy or students, that's just very complex because the real world is very complex. Real world markets contain a lot of market frictions. Think about just taxation. Taxation distorts a lot of our input parameters. So why is this a relatively challenging chapter sometimes? Because students keep asking me as I'm explaining something rather theoretical, yeah, but how does that work in the real world? How does that work in the real world? So full disclosure, what I'm gonna show you today does not work in the real world at all. Simply because we approach reality by basically building a very simplified model of reality. And we do this by making all kinds of assumptions. So we will start operating as if the world were very, very much simpler than it really is. So we say, okay, we operate in perfect capital markets. We agree that for now we assume there are no transaction costs. And most importantly, we will operate in a world with no taxes. No taxes. And that is relevant, okay? So please, for the time being, hold your horses. I understand, of course, that you're not going to university to learn some abstract, you know, brain jerk off. But we need to approach complex reality first by understanding a very simplified version of reality, and then bit by bit, we drop our admittedly very unrealistic assumptions and make it more lifelike, okay? For the time being, the biggest assumption that we will make is there will be no taxes. Does it make sense, guys? Yeah? So please don't be impatient. And again, I want to really stress this is not important because I'm your finance teacher. It's important to me sort of as a fellow human. You understand we live in the post-truth age. Since, I would say, President Trump, you know, fake news is thrown around a lot. When you look now at the corona epidemic and the anti-vaxxer movement, crap like this, nonsense like this, I think indicates and makes it more important for you as well as for me to not simply hold opinions on all kinds of things, but to also have reasons for our opinions. So please think of today's lecture not only of me telling you something that's very important, that would be a matter of 2 minutes, but think of today's lecture as a systematic approach to justifying why we think about a certain situation in a very specific way. Okay? As always, you can immediately interrupt when there's something unclear. Okay? Okay. Since we do something very new today, I actually have, of course, as always, prepared PowerPoints. The PowerPoints that I've uploaded will also keep us busy in our next lecture, which is tomorrow at 9 o'clock. Let's hop in. Boom. There it is. So, also please, today you will see there are a couple of slides that individually are rather challenging to understand because they rely on the previous slide and the next slide relies on the previous slide. So it makes sense to have these slides next to each other, and that's, I hope, where my smartboard can shine. So I think today could be one of those sessions where afterwards it makes sense that I share the notes from the smartboard with you. If you want that, just please remind me in our Telegram group. And before we hop in, last thing, not everybody is part of our Telegram group yet. Just join. If you have not joined yet, please do so. Let's have a look. So there are a couple of things that we have already elaborated on, that we have already diagnosed. We have already agreed, let me go here. We have already agreed that the cost of capital is important. I'm being a little bit casual here saying the cost of capital. We are talking, of course, about the weighted average cost of capital. And we said, well, if you are able to lower your cost of capital, this will increase the market value of the firm. Again, why? Because the WACC, the weighted average cost of capital, is our discount rate. So if I wanted to figure out the value of a whole firm, I could set up a very big net present value calculation, as last lecture I showed you in a very stylized way for Apple, and simply discount all the future earnings of the firm by the WACC. If I discount with a lower discount rate, so a lower WACC, the final firm value, the result of my net present value calculation, will be of course higher. So firms want, logically, as low a weighted average cost of capital as possible. If you say, now wait a second, I don't get this, that's super abstract and weird. No, it's not weird and it's not abstract. The cost of capital, think of it as an interest rate-ish that the firm pays on the capital that it obtains. This is perfectly real-life consistent. If you want to finance your new house, you also want that you finance it as cheaply as possible. The same logic holds here, of course. So the cost of capital is important. And also important, that's also what you have seen in our WACC calculations and also on the workshop, in the workshop on Friday with Celine. The cost of capital is impacted by the mix of debt to equity. So that changes. So then, of course, we have to figure out what happens depending on certain changes. If we increase leverage, that is just complicated finance language for you put more debt in your capital structure. An unlevered firm is an all-equity firm, a firm that has only equity on the right side of the balance sheet. That would be referred to as an unlevered firm. A levered firm is a firm with at least some degree of debt in its capital structure. And when we are looking at a firm that increases the amount of debt in its capital structure, we would refer to this firm as a firm that is levering up. It's just complicated finance language for taking on more debt. So if you increase the leverage, so if you lever up, if the firm levers up, if the firm loads more debt in its capital structure, this will increase the systematic risk of equity. What's the consequence of this? The cost of equity goes up. This is of course a mathematical statement. You have seen this with Celine's workshop, but that's also intuitive, I think. Think of it like this. You are a shareholder of my firm. And I'm an all-equity firm. What would happen if my firm goes bankrupt? Well, my firm. I'm just a manager. It's really your firm because you're the shareholders. If the firm were to go bankrupt, an all-equity firm, what would happen? Well, all assets would be sold, also fixed assets. The company will stop existing. and the proceeds from selling off all the assets would be used to repay whatever debt we have. If it's an all-equity firm, there's nothing to repay. So the proceeds from selling off all the assets would be distributed amongst the shareholders, like a liquidation dividend really. If, however, I'm a firm, I'm the manager of a firm, not all equity, I start levering up. So that means I obtain more and more debt for our firm in our capital structure. And then the firm goes bankrupt. What happens then? Again, you are the shareholders. What will happen? The firm goes bankrupt, but it's not all equity. I have quite a bit of debt in the capital structure. When the firm goes bankrupt, everything gets liquidated. That means all assets, current and fixed, will be sold off. And the proceeds from selling everything will be distributed not amongst the shareholders, but they will be used first and foremost to repay all the outstanding debt. If after that something is still left, that will be distributed amongst the shareholders, you guys. So that means logically, as a shareholder, in the case of bankruptcy, you're basically standing in a waiting line, and in front of you are all the creditors. So in front of you are all the people, the parties that have given loans to our firm, and they collect first. So that means the more debt the firm has in its capital structure, the longer the waiting line in front of you, in front of the shareholders in case of bankruptcy. All the people that have provided debt for us. So why is that more risky for you? Well, obviously, if you're the last in the line, then very likely when it's your turn to collect some of the proceeds from liquidating everything, there will very likely be nothing left. And indeed in the real world, if you look at a real life bankruptcy, after liquidating everything, typically there's between 2 and 4% left to pay debt. Or let me rephrase it, I said this in a clumsy way. After selling all the assets, the money from selling all the assets, current and fixed, is only enough to pay for between 2 and 4% of all the outstanding debt. So that means about 96% of all the people that have provided debt for our firm will already get nothing. Take an educated guess how much in a bankruptcy the average shareholder, so you, gets. 0. So that means increasing leverage increases the systematic risk of equity. That's just complicated finance language for you as a shareholder, the risk goes up as our firm is levering up. Why is that? You can make a note here in brackets, because the waiting line in case of bankruptcy in front of you gets longer. Does this make sense, guys? Is this clear? Nice, super guys. Okay. All right. So we need to, of course, discuss a little bit more how and why does leverage increase the systematic risk of firms' equity? Well, I already provided a sort of common sense explanation, so there's no need to address this at this point any further. But if the leverage increases the cost of equity, how does this impact the overall cost of capital and the overall firm value? So in my, not just thought experiment, in my explanation now, I said as the firm is levering up, the risk of equity goes up. So that's the risk that you as shareholders are exposed to. So that means, think of the risk-return trade-off. If you expose yourself to a higher risk as a shareholder, you're not against this, but you want to be compensated in a fair way for that. So you say, well, if the risk has gone up, shouldn't then also the return go up? And again, remember, the return that you want to earn as a shareholder is of course the firm's cost of equity. So if you say your risk has gone up, you want to be compensated with a higher return, your return as a shareholder is my cost of equity. So that means as I'm levering up, the cost of equity of the firm, of me, goes up as well. But the cost of equity is of course only half of the cost of capital, right? We've discussed the cost of capital, the WACC, consists basically of two components, the cost of equity and the cost of debt. So if the cost of equity goes up, how will the cost of debt react? And how will the overall cost of capital react to that? That's a bit of a question now. And we actually have to end with all kinds of questions. Is it advisable to have leverage in a firm's capital structure? Again, don't be weirded out, don't get insecure, don't start doubting yourself. This is just complicated finance language. What does this mean in human language? Is it at all advisable to have leverage in a firm's capital structure? In normal human language, that simply means, should a firm use any amounts of debt at all? Or is it better if it's an all-equity firm? If yes, how much debt should it use? In other words, is there an optimal debt-to-equity ratio? The term optimal here requires maybe 1 or 2 sentences of explanation. When would a debt-to-equity ratio in our finance people mind be optimal? Well, I would say a debt-to-equity ratio is optimal if it minimizes the weighted average cost of capital. And when I have minimized the weighted average cost of capital, what will I have maximized at the same time? Firm value. And that's the big question in finance, right? Again, brief sidebar, in our Telegram chat, there were a couple of interactions where I tried to stress the point that you should not get lost in details. So it's possible if you open the finance book randomly at a page, you will immediately find something that you don't understand and that you have no idea about. But that is not the approach I would recommend. Always try to look at the big picture first and then zoom in. So in our interaction so far, I noticed that quite a few of you seem to do it the other way around. Looking at obscure details and then freaking out over those details. And when I say, so why are you even thinking about this? Where does it fit into the big picture? Then students very often say, well, I don't really know. Then in my view, you've already taken a wrong turn. You should always start with the big picture, the 2 big questions: in which assets should I invest, how should I finance them, and then slowly dig deeper, okay? Okay, what ratio of debt to equity maximizes the shareholders' interests? What is the interest of the shareholders? Maximizing firm value. I have now a long thought experiment here. It is not complicated, and I noticed in the last years when I guide students through this, it seems like the final punchline is so underwhelming that students then sometimes think they have not understood it correctly. So maybe I should not oversell our conclusions from this. It's a thought experiment that hopefully guides us towards making a conclusion. If the past years are any indication, you will be slightly underwhelmed by the conclusion. That doesn't mean you have not understood it. It's just one step closer to the solution of our puzzle. Let's do this. So we are looking at a firm, JJ Sprint, whatever. They have a market value of 1,000 British pounds. The company has no debt. Brief sidebar here. Think about the exam for a second. This is a very good example. I can, just this sentence, the company currently has no debt. I can phrase this in, I don't know, 5 different ways, and it always means the same thing. I just want to demonstrate. I could write here, the company currently has no debt. I could write, it's an all-equity firm. I could write, it's an unlevered firm. I could write, it's a firm that has 0 leverage. All of this means exactly the same thing, okay? I just want to stress the point that a large part of what you perceive as the difficulty of finance is not finance. That's just our, forgive me for saying it, bullshit, pseudo-complicated language. Okay, so when you see stuff like this, try to get used to the terminology so that you can handle this better. Company has no debt, it's an all-equity firm, and each of the shares outstanding, the firm has 100 shares outstanding, currently sells for £10. Okay. Furthermore, the company plans on doing something now. The company plans to borrow £500, but not to finance assets. They want to do something really weird with it. They want to borrow 500, so they are an all-equity firm, but they want to change it. They want to lever up, borrow 500, and what they do with the 500 is pay the 500 to the shareholders as an extra cash dividend of £5 per share. That makes sense because the company has 100 shares outstanding. And if I have 500 pounds to distribute, how much does each share get? Well, £5. This is something that's slightly different compared to what we've discussed about dividends. We have discussed dividends refer to the proportionate share of the company's profits that are paid out to the shareholders. So this is clearly not a normal and ordinary cash dividend. This is an extraordinary cash dividend, okay? And we are gonna analyze now if this is a meaningful thing to do. Will this actually benefit the shareholders? Yes or no? There are a couple of assumptions we have to make, otherwise this will not work. The investments of the firm will not change as a result of this transaction. This is something, maybe you want to make a note here, when you read something like the investments of a firm will not change. What it means is the asset structure is unchanged and therefore all future earnings forecasts are also unchanged. Okay? That's what this means. And the question is, what will be the value of the whole firm after the proposed restructuring? So far, so clear. All right, let me have a sip. Okay, remember, we are looking at a firm. We start by knowing the company's market value right now is £1,000. The company wants to lever up to some degree, borrow 500. What do they want to do with the £500? Immediately pay it out to the shareholders as a surprise cash dividend. And we will go now through several scenarios and analyze what happens. And then try to, of course, make conclusions, make inferences that hopefully bring us closer to the question, is there an optimal mix between debt and equity? Okay, again, plenty of more assumptions. I will point out, when we have done all of this, all the stuff that was really given to us, because I don't want that you think I have done some sort of side calculations in the background that I'm not showing you, okay? So the management of the firm recognizes that, by definition, only one of three outcomes can occur from this restructuring. Restructuring of the capital structure from all equity to levering up. So what are the three scenarios that are possible now? Well, after restructuring, after introducing debt in our capital structure, firm value could increase, could remain the same, or could go down. There is no other scenario possible. Either it will go up, not change at all, or go down. The end. Our original value was 1,000. So what could happen? After the restructuring, we could find ourselves confronted with a firm value that is now more than 1,000, equal to 1,000, or less than 1,000. Okay, and then, as any firm in the real world would do as well, we consult with our investment bank. And the investment bank, the managers of the bank, tell us they believe that restructuring will not change firm value by more than £250, up or down. So that means if they think it's reasonable to expect only changes by plus minus 250, and we start with a firm value of 1,000, what firm values are we realistically looking at after the restructuring, after introducing debt in our capital structure? Well, it could be then that the firm value is 1,250, so that would be the starting firm value of 1,000 plus 250. It could remain at 1,000, or it could drop to 750. How did I get that? The starting firm value of the all-equity firm was 1,000, and our investment bankers estimate it cannot go down by more than 250, so that would be 750. Brief sidebar here, because I promised to point this out. This is a bullet point where I sometimes see students struggle for no reason. This is not the result of a calculation. This is not a secret formula sheet I'm utilizing. This is just given to us, okay? Again, we are in a very simplified world, and I try to drive home one specific point. And I'm using, of course, an example from our book so that when you study, you will recognize it. So there is no need at this point to worry too much about this. This was simply given to us by the experts from our investment bank in this example, okay? Okay, let's look at it. So I'm basically analyzing now the different scenarios. So we, as the management of this firm, we have to recognize that after our restructuring, there are infinite possible outcomes. Obviously, our lecture is slightly too brief that we can discuss an infinite amount of scenarios. So what we are looking at three representative outcomes. We look at one outcome where the firm value goes down, one outcome where the firm value stays the same, and one outcome where the firm value has increased. That's it. So let's look at it. So here we see the categories that we're looking at. We look at debt, we look at equity, and we look at firm value. This is our starting point. Originally, we were looking at an all-equity firm, an unlevered firm, a firm with 0 degree of leverage. So the company had 0 debt, the company had 1,000 equity. What's the firm value? Think about what I showed you very quickly, connecting to your workshop. What's the value? The value that the firm has to the creditors and the value it has for the shareholders. So this plus this, debt plus equity. So 1,000. That's our starting point. And then the firm says, now wait a second, we want to change the capital structure. We want to borrow 500 debt. We are looking here at 3 different scenarios. In each of the scenarios, the company borrows 500. So the company takes on 500 of debt. That's what you see here. Skip the second line for now. Skip this. This is otherwise giving you trouble. Let's look at the firm value. 1,250, 1,750. Where did I get this from? I go back one slide. It was given to us by our investment bank. The investment bank said, well, we think 3 scenarios are most likely because we think the firm value will not change by more than 250, either up or down. It was given to us. No need to obsess over it. So if firm value can go up by 250, 1,000 plus 250 would give us a new firm value of 1,250. You see this here. If firm value doesn't change, it will remain at 1,000. And should the worst case happen, firm value goes down by 250, then we have a firm value of 1,000 minus 250. That would give us the 750. Brief sidebar. Is everyone still on board? Okay, super nice guys, super. So what is relevant here, and that might make it necessary for you to utilize your first year accounting know-how. How is equity calculated? Well, it's simply the difference between all assets and your liabilities, right? That's the accounting equation. Assets equals liabilities plus owner's equity. So the second line, that is what I have really calculated actually. That is not given, that is a logical consequence now of us saying we have 500 debt and firm value based on the prediction of our investment bank might be 1,250. So how much equity must the firm have? Well, the difference. So that would be 750. That is how I get the 750 here. That would be then the value the firm has for the shareholders. And I do the same for the other scenarios as well. If the firm value remains unchanged and I know we have 500 debt, what's then the value of the equity? 500, the difference. And oops, oh, that's weird. So, and last but not least, if the firm value really has decreased to, or will decrease to 750, and we have 500 debt, what's then the value of the equity? Again, the difference, 750 total value, minus the amount of debt, 500, gives us a value of equity of 250. Okay? So basically, the first line was given to us, the amount of debt, and the last line was given to us, the firm value by our investment bankers. So the only thing I don't even want to say calculated, the only thing I derived myself was the second line to figure out how, as a consequence of debt and a change in firm value, the equity position would change. Is everyone still on board, guys? Nice. Okay, very well. Okay, let's analyze some more. We are now analyzing each of the 3 scenarios. You see, I'm dropping the all equity case now. We are only looking at scenario 1, 2, and 3. So the increase in firm value, unchanged firm value, decrease in firm value. And look how that impacts now the wealth of the shareholders. So this is not the firm anymore. This is now what happens in the pocket of the shareholders, of you guys. So let's have a look. We have discussed this in our refresher sessions that a shareholder has 2 sources of income. Why would you want to invest in my firm? For two reasons and two reasons only. Number one, you hope that my firm will be very successful, making big earnings in the future, ending up with relatively high profits, so net income in accounting language. The net income goes into the equity and into the retained earnings, and from there, I, the manager of the firm, can take it and pay it out to you as a cash dividend. So source number one of income for you guys, shareholders, is dividends. And secondly, what else can happen? Well, if my firm is very successful, I operate, every year the profits will be higher, and more people will think, that's an awesome firm, that manager clearly knows what he or she is doing, so I actually want to participate in this success story. So they will start buying the shares of the firm. The more people buy the shares of the firm, the higher the share price, the stock price will go. So if you have bought a share for 100 and a year later it's traded for 120, you could sell it for 120, and the difference, in my example 20, would be a sort of profit in your pocket. And that is called capital gain. So we are looking now at those two components of the income of you guys, of shareholders. What's in it for you? Dividends and capital gain, so increases in share price. Let's look at the dividends first, because that's super easy. Second line. Why does this firm anyway do this weird thing of borrowing 500? Are they financing any assets with it? No, they take the 500, the loan, let's say from a bank, and immediately pay it out as an extra cash dividend to the shareholders. So that's what you see here in the line dividends, 500, 500, 500. Because by definition, that's what the firm wants to do. What else do we have? Let's look now at the capital gains. Minus 250, minus 500, minus 750. How did I get these numbers? They were not given to me, I calculated them. Let me go back one slide. So let's look at scenario one. Initially, the equity value was 500 and it has increased to 750 based on the increase in the firm value, based on the estimate of our investment bank. So what can we diagnose? We can diagnose that there would be a change in the position net gain or net loss to shareholders of 250. Initially, compare this, the equity position was 1,000 because it was an all-equity firm. After the restructuring, the equity value goes down from 1,000 to 750. So that's not good for you shareholders. That's what's represented by the minus 250. But what happens net in your pocket? It's true, your capital gains are negative. So the value of the equity has decreased, but that's not the only thing happening in your pocket, because you also have now the extra cash dividend in your pocket of 500. So what is the net change of money in your pocket? 250, it's just the difference. I'm just summing this up here. What happens in scenario 2? In scenario 2, let's go back. We initially said an unlevered firm in this scenario would have an equity value of 1,000. After the firm levers up, in scenario 2, the equity portion will only be 500. So what has happened in terms of capital gains? You as a shareholder will incur a decrease in the capital gain of 500, down. But at the same time, you get 500 cash from me. That's this extra cash dividend that I'm able to pay out because we have levered up. What's the net change in your pocket? 0. And last but not least, let's look at the capital gains in scenario 3. So in the scenario where firm value goes down, have a look here. Initially we had an equity value of the unlevered firm of 1,000. After levering up, and should the scenario happen in which the firm value goes down, the equity position decreases from 1,000 to 250. So that's a change of minus 750. That's what you see here. Boom, minus 750. What else happens in your pocket? Still, you get the 500 cash dividend. So what is the net change happening in your pocket? Minus 250. So far so clear, guys. Is everyone on board? Does everyone understand where I get every single number from? Super, very nice guys. Okay. And now we simply summarize what we are observing. So there's nothing new here anymore. Okay, as I've said, all of these were estimations, right? We asked the investment bank, hey guys, what do you think will happen to our firm value when we borrow 500 and pay this out as an extra cash dividend? And they said, well, 3 scenarios. Firm value will go up, or it stays the same, or it will go down. And then they clarified their estimation, if you will. They said, well, we actually think if firm value goes up, it will not go up by more than 250. If the firm value goes down, it will not go down by more than 250. So the thing is, we don't know at all which of these scenarios will actually happen. Imagine now that the managers of the firm, me, thinks that outcome 1 is most likely. Outcome 1 was this here, right? An increase in firm value. Imagine this is most likely. Should the firm then restructure, yes or no? What do you think? Don't be shy, unmute yourself or sound off in the YouTube chat. Should the firm restructure if we think scenario 1 is the most likely scenario? I see a lot of shaking heads. Unless you're listening to metal, I guess you think they should restructure. Nice. Okay. You're absolutely right. Yeah, sorry. Why, if scenario 1 is the most likely scenario, why would we conclude, yes, the firm should restructure? Because initially the firm value was 1,000. After restructuring in scenario 1, firm value will have increased to 1,250. Is this good for the shareholders? If you're looking at it now very casually only, you might actually say, no, that's not good for the shareholders, because initially the equity part of the balance sheet was worth 1,000 and now it's only 750. So that's of course less. How can we conclude, yes, the firm should restructure? Because this is only half of it. This is only looking, of course, at the capital gain side. We must not forget that capital gains is only one thing that will happen to you, to the shareholders. You will also get, of course, the cash dividend. So you, as shareholders, would be better off in scenario 1 after restructuring. How much better off would you be? You would be £250 better off. So yes, if we think scenario 1 is the most likely scenario, then we should restructure. Yes, I'm adding here the explanation, but that's exactly what we have discussed. Even though the price of the shares goes down by 250, so drops from 1,000 to 750, you must not forget that you have, ka-ching, actual cash dividend 500 in your pocket. And you have 2 sources of income, dividends and capital gains, okay? Don't make the mistake of only looking at the dividends or only looking at the capital gains. Both together, the net position, that is what matters. And here I'm simply explaining how we actually ended up with this number. Color-coded it a little bit that you see what is what. That's it. Imagine now that we believe outcome 3 is the most likely. Let's go and look at scenario 3. Scenario 3 is this one. That's the scenario in which firm value after restructuring, so after we have stopped being an all-equity firm, after we have decided to lever up, after we have decided to become a leveraged firm, where the firm value goes down from 1,000, it drops to 750. Should we restructure then? Well, at a first glance, we would say no, because the value of the equity, so for you shareholders, decreases, goes down from 1,000 to 250. So that's bad. At first glance, we should say no. Let's look what the second glance says. Don't forget, this is representing capital gains. That's only one source of the shareholders' income. We need to factor in dividends as well. So at first glance, restructuring in this way, levering up by 500 with £500 debt in scenario 3 seems ill-advised. Let's see. At second glance, well, you do get 500 dividends, but the decrease in the capital gains by 750 is not offset by the cash dividend. So in total, you as a shareholder are worse off by 250. So even at a second glance, we cannot conclude anything differently, but if we think that scenario 3 is the most likely scenario, we should not restructure, because restructuring would actually make the shareholders, you guys, be worse off. How much worse off would you be? You would be £250 worse off as compared to the all equity case. Is everyone still on board, guys? Super good, really nice. And last but not least, imagine that we think scenario 2 is the most likely scenario. I mean, that's super unspectacular. What can we say about scenario 2? Well, firm value does not change. The equity value goes down from 1,000 to 500. So you have a negative capital gain. That's what you see here. The share value goes down by 500. Is this a problem for you shareholders? Not really, because as the share value goes down by 500, at the same time, I'm also giving you £500 cash in your pocket. What's the net effect? Nothing. So would we do the restructuring if scenario 2 were the most likely scenario? We would not do it, because it's a lot of fuss, it's a lot of work, it's a lot of paperwork. And at the end of the day, nothing changes in your pocket. Everyone on board, guys? Okay, nice. Yeah, almost done. Well, almost done with this, not with the whole lecture, of course. Okay, oops. So, and we have arrived at our first conclusion. Like I said before already, prepare to be underwhelmed. In the past, I learned students are not nearly impressed as they should be, I think. So this is really important. Today, by the way, I cannot display my exam sign, because I need one more laptop for my setup, which I don't have yet. But imagine now the red exam sign with exclamation marks, all right? This is now what we can learn from this example, from this thought experiment. Changes in the capital structure benefit shareholders if and only if the value of the firm increases. Otherwise, there will be no benefit to shareholders. If and only if. So if the changes hurt shareholders, let me start differently. The changes in the capital structure will hurt shareholders if and only if the value of the firm goes down. So that's, I think, important conclusion number 1. A restructuring is only beneficial to shareholders if and only if the value of the firm goes up. And a restructuring will only hurt shareholders if and only if the value of the firm goes down. And what does this mean for the real world? What does this mean for management in the real world? You should choose the capital structure that you as a manager believe will have the highest firm value. Why should you do this? Because this capital structure will be the most beneficial to the shareholders. Is this clear, guys? This is really, like I said, this is an in-between conclusion. Of course, there's plenty more to elaborate, but this is a starting point. All right? Okay, guys, let me check the time. It's almost perfect timing. Guys, shall we have a quick coffee break? 10 minutes? Today I also don't have a break countdown, like I said, because of the laptop. Can we reconvene here in 10 minutes? Let me see on my... Wait, I just started timer here. It's 9:49. Let's be generous. Let's reconvene here at 59. Super, guys. I see you in 10 minutes. Perfect. So guys, come back to me. Come back to me. Super. Okay, before we move on, the only thing that I have done in the break, well, I had a coffee, but what I have done is I've taken quick screenshots of the key slides from our thought experiment, simply that I can quickly guide you through that. I want to eliminate all possibilities of misunderstandings here. What I would like to do is, I would like to briefly circle all the stuff that was given to us, because I would not want... I see a black screen. Oh, sorry, yeah, that's me. Sorry, guys. Thanks for pointing it out. There is a video now. Sorry, guys. I want to make sure that you are not struggling at home when you go through this yourself with being unsure what I calculated and what I did not calculate. So this was our starting point. No debt in our capital structure. The firm value was established, first sentence. What else was established? That we will take on debt, 500 in each scenario. Furthermore, what was also given to us, that was the input from our investment bank, that firm value could go up by 250, stay the same, or go down by 250. So all of this was given to us as well. Consequently, I had to then calculate myself, or we had to calculate ourselves, the impact that this will have on our equity. So what I circle in green is really stuff that we have calculated ourselves. And everything else then was a logical consequence. One more thing that was given. It was given that we will pay out the 500, the debt, as a dividend. So this here was given to us. This is not something I have calculated myself. And everything else is really something we have figured out. And then on the next 3 slides, I explain each scenario. Okay? So that is how you have to read this. This is for scenario 1. The second one here is scenario 3. And the last one is the middle case where nothing changes. So that's how you have to look at it. Okay? Okay. Now, let's go back. Oh. Save. All right. All right, there we are. I wanted to briefly, that's really something that I don't want to say has nothing to do with our course, but it's relevant to me personally. Everything I'm almost forced to talk to you about in this course revolves around our prime objective, maximizing shareholder value. And I cannot help myself but point out what I think is a problem about this. So we always say, what should a company do? What should the manager of a company do? Maximize shareholder value. And if you think about it, that's not that complicated. How do you maximize shareholder value? By maximizing the value of the firm's equity. So then we have to ask ourselves, what influences the value of the equity? Well, one important position within equity is retained earnings. And retained earnings is basically the basket in which we put the profits from the past. So how can I maximize equity? By maximizing retained earnings. How can I maximize retained earnings? By maximizing profits. How do I maximize profits? We're almost there. Well, profits is a difference between, I'm simplifying but only a bit, revenue minus expenses. I mean, that's what net income at the end of the day really is. So when you say let's maximize shareholder value, you're really talking about maximizing profits. And when you talk about maximizing profits, you're really talking about maximizing revenue and minimizing expenses. So how do you maximize then shareholder value? By maximizing revenue, minimizing expenses. How do you do that? Let's talk just 2-3 sentences. How do you maximize revenue? Different ways. I'm not qualified enough to talk to you about this. That's something you should discuss with your marketing professors. My simple understanding would be brainwash your customers into submission. Advertisement, right? Advertise, advertise, advertise. Convince people that whatever it is that you're producing, that they need and that they will buy. I think, I mean, feel free to have a different opinion. I think Apple is very good at this, convincing us all that we need whatever, Apple devices, that we did not know we needed before we saw the advertising. And secondly, how do you minimize your expenses? Again, that is not, I mean, it's just the truth now. I don't recommend doing this. But an easy way to minimize expenses is, of course, outsource your production to a country, for example, where human rights count for very little. I don't need to have my whatever running shoes produced in Germany by grown-up people with social security. I could have my running shoes produced in whatever, Bangladesh or something, a country like this. I could have, of course, child laborers. That's super cheap. I don't need to invest a lot in safety measures in my factory. So a couple of workers die every year. Big deal. There are plenty of people. So, like I said, this is not my opinion now, but this is how large conglomerates, large corporations very often really act. They maximize shareholder value by maximizing revenue through brutal marketing, targeting, for example, children. And secondly, minimizing expenses through practices of child labor, for example. So what I'm saying, that mathematically, that will maximize your shareholder value, no doubt about it. So the point I'm trying to make here is when you read in a corporate finance textbook, or when you hear me say this, you should be maximizing shareholder value. If you apply this, I think, consistently, it must lead to unethical outcomes. Okay, so I don't want that you think corporate finance exists in a sort of ethical vacuum and the stuff we do, this would not be a victimless crime. That's what I'm trying to say, okay? So please consider when you read in a corporate finance textbook, when you hear me say this, shareholder value maximization, that it's very, very quick, it can go very, very quickly, that you end up doing something unethical, okay? So shareholder value is not only a good thing. All right, I have uploaded yesterday also on Canvas an Excel sheet. I would like that you feel free to open it now, of course, and watch along with me. I just need to open it quickly. Exit, boom, okay. Let me switch on my laptop very briefly to the Excel. So. Here it is. Here it is. Okay, guys. So first of all, there are a couple of things I want to point out just before we hop into the actual case. So this is how I think an Excel sheet should be structured. In our Telegram group, we spoke a little bit about exams. And some of you asked, well, when will there be a formula sheet? Well, I already said several times, there is no formula sheet because it's an open book exam. I mean, the internet is your formula sheet or the textbook is your formula sheet. So you can use whatever tools basically you want, not identity, fraud, but beside that, create whatever formula sheet you feel will help you. And I suggested, or I said, if I had to do the exam myself, I would show up with the most overpowered Excel sheet the world has seen. I would obviously, if I'm a student, part of a group of about whatever, 1,800 students, I mean, it makes sense to do this in a collaborative effort. I certainly would do. Sometimes I see then that students try to work on an Excel sheet together and it does not always work because people design Excel sheets very differently. So I'm quite proud of this sheet because I find it is very transparent. If I would give this to you, which I have, and I don't say a single word about it, you actually are able to figure out what's going on because you're not even forced to click in every cell to see what formula I'm using. Next to each cell where I have a formula going on, I'm explaining, has this information been given to me? Or if not, how did I calculate it? And on top of that, I color coded it. So if I were a student and I would give you this sheet, this is a typical, let's say, workshop exercise, and I want that you proofread it, you could actually do this with investing a minimum amount of time. So if you create an Excel sheet, make sure that it is clear for an external reader. Also make sure that if you look at this in 3 weeks, you still know what you were thinking when you created it. So I think it's a rather good template for how an Excel sheet should be designed, should be structured. What it is about, let's hop into it. We are of course analyzing changes in the capital structure to see if we can make certain inferences about what a firm should be doing. And we get all kinds of information. So this here is the current situation the company is in. This is all given to us. As you can see here, I have all kinds of things that I'm just at the moment hiding that are just more explanations, okay? How each information was retrieved. So we know from the beginning on, the company has assets worth 8,000 euro. The company has no debt at all. So it's an all equity firm. It is unlevered. It has zero leverage. Furthermore, the company has equity, market value, as well as book value of 8,000 euro. The interest rate is 10%. That's also given to us. Then we calculate the market value per share. Well, that's super easy. That's what I'm doing in this cell. Equity divided by shares outstanding. We have 8,000 equity. We have 400 shares outstanding. So the market value per share should be 20 euro. Okay? So, and then there is a proposal on the table that the management of this firm discusses. The company says, well, we should actually take on debt, we should lever up, we should take a loan of 4,000 at an interest rate of 10%. What are we gonna do? What are we gonna do with the 4,000 that we borrow? We buy back our own shares. That is possible. So that's not an investment. It's not like you or me buying shares to hold this, to earn dividends or something like this. A company can really buy back its own shares. We will discuss this in our chapter dividend policy in great detail, why that is actually a good strategy. For the time being, how does it play out? Well, if one share currently is traded for 20 and we have 4,000 that we just obtained in debt to buy back some of our shares, how many shares can we buy? Well, we can afford to buy 200 shares. So that means initially we had 400 shares outstanding, but with the 4,000 that we take on in new debt, we are able to buy back half of them. So that's why you see here, I have now, after this proposed change, I have only 200 shares outstanding. Okay? And as I said before, you can just look at what I'm hiding here with the explanation of every single line item. Okay? Okay, so that is our starting point. And then we look at certain scenarios. We look specifically at 3 scenarios. We look at a scenario, again, this is very stylized, this is very simplified. In the real world, there's an infinite amount of possibilities, of course. We are looking at 3 scenarios. There could be a general recession. There could be what we usually call an expected scenario or a most likely case. And there could be an economic expansion. All equal probability, but for our example, it doesn't even matter. And then we analyze what will happen in each of these 3 economic scenarios. First, if what happens in our old capital structure, how would that impact our firm or our shareholders? And then in a second step, when you scroll down, you will see we do the same analysis for recession, expected and expansion with the new proposed capital structure to see are there any differences, and if yes, which differences. What I want to do is, just for your expectation management, all scenarios work in exactly the same way. The calculations are exactly the same kinds of calculations. So I just want to do essentially one scenario to save a little bit of time, otherwise we would need probably an hour more. But you see that also for scenario 2, the expected case, as well as for the expansion scenario, I have the detailed explanations here, and it's literally copy-paste from the first scenario. Okay, so there's no need to worry that I'm skipping the one thing that's really difficult. They are all mathematically exactly the same approach. Okay, so we look at the recession scenario. I'll show what's going on. So just we calculate a couple of different metrics so that we can compare a little bit. So we try to get a little bit of data before we can make any inferences and any conclusions. So one of the things I calculate is the return on assets. How did I do this? Well, that's given to us, earnings. In the recession scenario, our company is expected to generate earnings of 400 euro a year. So that is not something I've calculated. As you can see, that was given to us. And if I then want to calculate the return on assets, I can easily do this. I simply need the earnings, that is 400, and I need to know the amount of assets. So we have 8,000 assets. That's also given to us. So I'm simply calculating 400 earnings, 400 euro divided by 8,000 euro, and I multiply with 100, so that what I'm seeing here is really a nice and even percentage, 5%. What's the return on asset? In the no debt scenario, in the all equity scenario, 5%. Okay, then I also calculate the return on equity. Also easy to do. How do I do that? Well, I take the earnings and I divide the earnings not by assets but by equity, the return on equity. So I have 400 earnings, that was given to us, divided by the equity. In the all equity case, we have 8,000 equity. So my final calculation will be 400 euro divided by 8,000 euro, and I multiply with 100 so that I get nice and even percentages here as well. So we end up with a return on equity of 5%. And last but not least, I want to know what does this mean now for the shareholder, for a person that holds one share. So I calculate, this is also a very important real life metric, the earnings per share. So the earnings that can be attributed to one single share. Now, easy enough. I simply take the earnings, 400, they were given to us, and I divide them by number of shares outstanding. So how many shares of our firm are in circulation? So we have earnings of 400 and I divide by the shares outstanding, the 400. So I end up 400 divided by 400, important, 400 euro, that are the earnings, divided by 400, that's a number of shares, 1, 2, 3, 400, and that gives me earnings per share of 1 euro per share. So far so clear. Is everyone on board? So first of all, is it clear what I'm saying? So when I guide you through this, and secondly, do you also see a little bit how the Excel sheet works? So these here, what I have in column D, that are not calculations, that's just a simple way for me at least to track a little bit the formulas I'm applying. Is this something that you understand what I'm doing here? It's not too weird and cryptic. Super. Okay, very nice. All right. Okay. Like I said, right, we have other scenarios as well. We have the expected scenario and the expansion scenario. I will really spare you this because that's just a reading exercise at this point. I go literally through the same steps. Let me maybe show you that you see this. Cannot really scroll yet. Just that you see. So we have here the scenario we've just discussed with earnings per share of 1. And you see the formulas I'm using are literally the same as here. Okay? So this will not give you any problems. If you understand scenario 1, the recession, you will also not struggle with the expected scenario and with the expansion scenario. Okay, so we have figured out now our earnings per share. Okay? So keep this in the back of your head for now. I'm moving down. We have now analyzed the current state. So an all equity firm in this recession scenario. And what we do now, we are the management of this firm and we have to figure out if this proposed change in the capital structure, meaning taking on 4,000 euro in new debt and using this new debt, the 4,000, to buy back our own shares. So basically, when we buy back our own shares, we're reducing the number of shares outstanding. Okay, that's what happens. So let's do the analysis. Again, I need a couple of data points so that we have enough data to make meaningful conclusions. So like before, I start by calculating a return on assets. Now, please note, I'm now a little bit more accurate. Here I just said earnings and now I'm saying earnings before interest. Why am I distinguishing here? It's very easy. This is an all equity firm, no debt. So that means earnings before interest are here the same as earnings after interest because we have no debt. that means we don't pay interest expenses. So that's why I can be here a little bit sloppy in the wording. And that's why I cannot be sloppy in my wording here. We're talking about earnings before interest. We have taken on new debt 4,000 at an interest rate of 10%. That was also given. So it stands to reason that we have to pay interest expenses now, when before, in our all equity scenario, we didn't. So I have earnings before interest of 400. That was given. The return on assets will not change, since we simply use the earnings before interest. So it's literally the same calculation as in the all equity scenario. However, I need to then calculate our interest expense. How did I do that? Well, simple enough. I simply said, okay, we borrowed 4,000 euro at an interest rate of 10%. So what is the interest expense? Well, 4,000 multiplied with 10%, and that gives me an interest expense of 400 euro, minus 400. Okay. And knowing now our interest expense, I can calculate our earnings after interest. It's simple enough. That's calculated as earnings before interest, so the 400, minus our interest expense of 400, and that gives us earnings after interest of 0. Is everyone on board? Okay. Okay. We calculate now our return on equity. This is now slightly different because we have now our earnings after interest. Earnings after interest divided by equity. Our earnings after interest, we've just calculated, they were 0, and we divide by equity. Our equity after, initially we had 8,000, but then we got 4,000 debt, repurchased, bought back half of our own shares outstanding. So now we have only 4,000 equity in our capital structure. So that gives us a return on equity of 0. And consequently, when we calculate our earnings per share, we also end up with 0. Why? Because we have 0 earnings after interest. Okay? Everyone is on board. Super nice, guys. Okay. Like I said, please complete scenario 2, so the expected case, so the most likely case if you will, and the expansion case, simply for practicing this kind of reasoning. Okay? Okay, let's go down some more. We have now a conclusion already. The first conclusion that we can draw is this: the effect of financial leverage depends on the company's earnings before interest, on this here. Okay? So this is an important in-between conclusion. But this is not even where I want to go with this. Again, I want that you imagine now, I don't have the other laptop that I can show the flashing exam sign. Please picture it, okay? This is super, 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 super exam relevant. We are looking now, so this is the firm perspective. We have calculated a couple of metrics like earnings per share that are relevant for shareholders, but essentially we are operating here within the company realm. And now we look at what that means from the investor perspective. What I want to do is I want to compare now 2 different trading strategies and see how they play out. Okay? The worst is, I would say, almost behind you. So we're looking at strategy A. Let me describe strategy A. That's, like I said, this is not the firm perspective, this is the investor perspective. This is your perspective as a shareholder. Because we also want to know what would you prefer as a shareholder. Which capital structure benefits you the most, and therefore which capital structure would you want to have the most. So strategy A is relatively simple. It involves simply buying 100 shares of levered equity. Again, this sounds very complicated, but it's just finance blah blah, complicated finance language for a very simple thing. It means your strategy A consists of buying 100 shares of the company after it obtained debt. So levered equity means it is not an all equity firm anymore, it is levered, meaning the company has some degree of debt, of leverage in its capital structure. So this would be strategy A, means you buy 100 shares of the firm after this proposed restructuring, okay, of the levered firm. What will change then? Let's look at it. Well, we have already calculated our EPS, so earnings per shares, of levered equity. That's something we have done in C29, that is this cell here, okay? We have calculated this, so we already know the earnings per share of levered equity would be 0. We also know if you bought 100 shares of levered equity and each of these shares has earnings per share of 0 and you have 100 of them, what is then your earnings per 100 shares? It would be earnings per share, per one share, multiplied with the 100 shares that you just bought. However, 100 times 0 is sadly still 0. And last but not least, we ask ourselves, if you want to engage with this strategy, if you really want to execute trading strategy A, how much money would you have to bring to the party? How much would going for this strategy actually involve? How much would you have to pay for it? Or in official finance language, what's your initial cost of this strategy? Now yeah, 2,000 euro. How did I figure that out? Equity divided by shares outstanding. That would give us the price of one share. And then I multiply with however many shares you want to buy. 100, right? Because that's our trading strategy, 100. So the calculation would be after the restructuring, because we're talking about levered equity, it's not all equity anymore. After the proposed change, the firm has only 4,000 equity left, divided by shares outstanding. Well, how many shares after the restructuring do we have left? Initially we had 400, but we borrowed then 4,000 euro and bought back half of our own shares, so 200 of them. That means only 200 shares are in circulation at this point. So that's what you see here, 4,000 equity, 4,000 euro equity divided by 200 shares outstanding, and that gives us an initial cost of 2,000. So far so clear. Again, please complete this for the second and third scenario yourself. But that is trading strategy 1, okay? Simple enough. Clearly the assumption, or what's happening in the background, is that we are assuming you are a shareholder that is not in principle against owning shares of a company that is levered, that also has debt in its capital structure, right? But what if you don't want that? So that is now the second trading strategy, strategy B. Strategy B. This is now a little bit more complex. So this involves more steps. It's not as simple as, I buy the shares, what's going to happen? This involves more steps. Have a look. So let me first describe what trading strategy B actually consists of. You borrow money. You borrow 2,000 euro yourself at 10% from the bank. Brief sidebar here. You already see that we are in a simplified reality here, because the interest rate that you borrow at is clearly the same interest rate at which the company borrows. That is not the case in the real world. Also, I'm pretending here there are no transaction costs. When you go to a bank and you ask for a loan, there are always some extra fees on top of, right? So clearly this is a stylized example in a simplified world. That is not real world stuff yet, okay? So trading strategy B involves step 1, you borrow money. How much? 2,000 at the same interest rate at which the firm can borrow, the 10%. But what do you do with the 2,000 then? Well, you use the proceeds, so the 2,000 that you just borrowed, plus, I don't know if you can see this on the screen, it looks okay, plus your own investment of 2,000 euro. So that's the same 2,000 euro that you had available for trading strategy A. It's literally, that's why I've color-coded both in this super intense blue. So you borrow 2,000 and you have the 2,000 in your pocket, okay? So you have in total 4,000 available. What do you do with the proceeds from borrowing and your own investment of 2,000? You buy 200 shares of the unlevered firm. And the unlevered equity, you remember, we've calculated this a little bit above. The market price per share then of the unlevered firm, so before this capital structure change was 20 euro per share. Okay, so that's it. What's trading strategy B? It involves essentially two steps. Number one, you go to the bank and you borrow 2,000 euro at 10%. Step two, you take the 2,000 that you just borrowed plus the 2,000 that you already had, which you already had available for trading strategy A, and purchase shares of our firm, but before the capital structure changes, okay? How will this play out? Well, you can then basically afford to purchase 200 shares of unlevered equity. So that's the shares of the firm that is unlevered, that are shares of the all equity firm. So, let me go there. Before the proposed change. So, shares of this firm, not shares of this firm, okay? So far, so clear. Okay. Okay. And then we analyze what happens. So you now have 200 shares of unlevered equity, shares of this all equity firm that will pay you earnings per share because it's unlevered, right? In the unlevered case, we diagnose that the company will have positive earnings per shares, and we multiply with the 200 shares that you were now able to purchase. And the earnings per share, let me scroll there as well. In the unlevered scenario, earnings per share, in the scenario no debt, in the recession case, 1 euro. Then, that is what you see here. 200 shares that you own of the unlevered firm, multiplied with the 1 euro, that's the earnings per share of the unlevered firm, and that would give you then earnings per the 200 shares that you just bought. So you would have a cash inflow of plus 200 euro. So that's okay, but you borrowed 2,000 euro from the bank at 10%. That's not for free, obviously. You need to pay 10% interest expenses, so you need to still factor this in. So that is your interest expense here, minus 200. So what is then the position net earnings? What's happening in your pocket? You earn from the 200 shares of unlevered equity, 200 plus 200 euro. But at the same time, you also have to pay interest expenses of 200. So the net earnings, what will happen, the net effect in your pocket is nix, zero. Do you understand those two numbers here? The plus 200, where I got them from, and the minus 200, where I got them from. Is this clear, guys? Any questions? Let me hop into the chat briefly. I don't want to overlook anything. Okay, seems like everything is cool. Let me click this away. All right. Okay, super. Okay, what I will do now is I close this so that we see the overview here nicer, okay? Like I said, scenario 2, so the most likely case, and the expansion case, so the third scenario, they all follow the same logic, so that you will not have any problems. I want to draw your attention now to essentially, well, basically our conclusions here already. Have a look. I would like to draw your attention specifically to this and this. So, if you follow trading strategy A, you buy 100 shares of levered equity, so after the proposed change. So that's not an all equity firm anymore, that is a levered firm. That's a firm that has some degree of debt in its capital structure, quite a bit actually. And in the three scenarios, what will happen to you as a shareholder then? Well, in the recession, you will end up with a cash flow of 0. In the most likely case with plus 400. And in the economic boom phase, in the expansion phase, of plus 800. If you follow trading strategy A. If you follow trading strategy B, you will have in the recession a cash flow of 0. In the most likely scenario, plus 400. and in the economic boom, in the expansion, 800. What do you observe here? Please unmute yourself and shout at me. Is there anything worth pointing out? Don't be shy. Is there anything that sticks out to you? Don't be shy, guys. Yeah, wait a second. Yes. You're absolutely right. Sorry, I had you guys on mute. Shout at me.
So I think the bottom line stays the same whether we borrow, we have to pay interest, or if we don't borrow and buy the unleveraged shares, we have like less capital gains in this case.
Yeah.
Bottom line stays the same.
Yeah, Michael, thank you very much. You're absolutely right. What does this mean? Please pay attention to the ingredients that we utilized and the final outcome. Here, trading strategy A involves purchasing shares of a company that is levered. What's the outcome of this? 0, 400 or 800 in the three scenarios. If the company did not do this, if they don't go for this proposed structure, if the company decides to remain all equity, you could follow trading strategy B, purchase unlevered equity because the company might decide not to go through with levering up, with obtaining more debt. What will the outcome be for you then? 0, 400, 800. What does this mean? It means it doesn't matter. This is involving a trade with levered equity. This involves a trade with unlevered equity. And the outcomes are exactly to the cent the same. So what can I conclude from this? What can I conclude? Is this relevant? Is this not relevant? Yeah, it's super relevant. We have looked here. Everything below line 36 is the investor perspective. We have a super important conclusion here now. It doesn't matter. It does not matter, or it should not matter for you as an investor if a company is levered or if it is unlevered, because you as an investor can artificially create any degree of leverage in the firm whose shares you have in your portfolio. So you should not, based on this example at least, in the simplified world, you should not really, it should not matter at all. You would be completely indifferent if the firm is levered, if the firm is unlevered. You can achieve the same payoffs, 0, 0, 400, 400, 800, 800, in either scenario. Why are we going through all of this? We are trying slowly to approach the question, what should a firm do? How should a firm finance its assets? And part of the considerations is, of course, what do the shareholders want? The shareholders want maximized firm value, and we find out now, at least in my simplified world, where I have made all kinds of assumptions, it does not matter at all. Okay? Let me go to my slides again. I will close this now.
I have one question.
Shoot.
So why do we in the first strategy just buy stock of a levered firm, and in the second strategy we buy stock of an unlevered firm, but at the same time we also borrow money? Why do we borrow this money in the second strategy and just not buy stock of an unlevered equity? I don't know.
Point taken. Point taken, I understand. So these scenarios are in a way mutually exclusive, right? Because you cannot buy levered equity of the same firm as you can buy unlevered equity from the same firm, because either the firm will be levered or it will be unlevered. So the question was now, why do we borrow money under trading strategy B? The reason why I'm doing this is I need here minus 200. So the interest expense. Why do I need the minus 200 here? If I did not borrow money, I would not be able to achieve the same payoffs here as in the scenario of buying levered equity. So I've constructed trading strategy B specifically in such a way that the payoffs of strategy B are perfectly identical to the payoffs of trading strategy A. And I'm utilizing, and how I do this, or the reason why I do this is I want to show you that it doesn't matter if the firm is levered or unlevered, because by doing all kinds of different relatively complex things, I can achieve exactly identical payoffs. So the borrowing is necessary, otherwise the payoffs would be very different and I would not be able to drive home the argument I'm making. Does it make sense?
Makes sense.
Is the reason for this that the earnings per share are different for the unlevered and levered firm?
Yeah. Yes.
Okay.
Yes. Yes. Okay.
We basically borrow more, or we have to borrow more money to achieve the same bottom line from the unlevered firm, and that's the reason why we take the loan, right?
Yeah, I would not even go down that road. What I would say is, and that's really the conclusion from this example, it does not matter for your trading activities in this simplified world that we are for now operating in. It should not matter to you as a shareholder if a firm is levered or unlevered, because artificially, through relatively complex moves, you can duplicate, you can mimic the payoffs of a levered or of an unlevered firm. Okay, that is the main gist here. And last thing about this, there is a term in corporate finance for strategy B. Strategy B involves buying unlevered equity, so buying the shares of a firm that has no debt in its capital structure, but clearly trading strategy B would be executed by an investor, by a shareholder who actually wants to hold shares of a levered firm. So what can you do? You're interested in this firm, you want to be a shareholder of this firm, but not of an unlevered firm, not this firm in an unlevered state, I should say. So trading strategy B in finance is called homemade leverage because, and that is really exam. And what that means is, even though you buy unlevered equity, you buy shares of an all-equity firm that has zero debt, you end up with the same payoffs as the firm in the levered scenario, or I should say as the investor that has bought shares of this firm in a levered state. So that is why we call this homemade leverage, because if the firm says, no, we want to be an all-equity firm, and you say, yeah, but I'm a shareholder, I don't want to be a shareholder of an unlevered firm, you can create artificially the leverage that you want to see in the firm within your portfolio. That's why it's called homemade. Doesn't matter what the firm wants, all equity, not all equity, who cares? You can do this yourself as an investor, as a shareholder. That's why homemade. Why leverage? Because homemade leverage means using unlevered equity, you're still able to manage the same payoffs as you would earn from being a shareholder in the same firm that has levered up. That is the main message, and I'm almost done. Does it make sense, guys?
But why do you borrow money? Because if you don't borrow money, you'll have a higher return.
Yeah, but that's not the point. That is not the point of this example. I'm not showing you trading strategies that maximize anything. What I'm showing you, Eva, is that it doesn't matter if a firm is levered or unlevered, that we can artificially, by using the same amount of money, please note that, in each case I only brought 2,000 euro to the party. So even though I spent the same amount in each trading strategy, I can achieve the same payoffs, 0, 400, 800, 0, 400, 800, no matter what the company decides to do, if it wants to lever up or if it remains unlevered, by utilizing the same amount of money, that's the 2,000 in blue, that's the money I already had, I can achieve the exact same payoffs. So Eva, you are right, yeah, I don't have to borrow money here, then the payoffs would be different, but that's not the point I'm trying to make. The point I'm trying to make is, it does not matter for you if the company is levered or unlevered, because you can mimic, you can artificially create the same cash flows no matter what the firm decides to do. You can do this at home, homemade. And if the firm is unlevered, you can, as a shareholder, yourself in the sanctity of your home, create the desired leverage artificially in your portfolio, even though the firm remains all equity. And in order to match the cash flows 0, 0, that is why I borrow the money. Okay, again, don't think of this as profit maximizing trading strategies. It's not a class on trading. I'm trying to make the case that it does not matter in this simplified world we are for now operating in, if the firm is levered or unlevered, with the same investment, you can duplicate, you can mimic, you can replicate, as we would say in finance, the cash flows in each scenario exactly, precisely. Make sense, Eva?
Yeah.
Nice.
Thank you.
All right, let me click this away. Let's shoop. Whoop.
Sorry, I have a question.
Shoot.
This is just an example to show us that that it's not, that it doesn't matter if the company is levered or unlevered. But should we also be able to derive to that conclusion with the calculations, or was it just to show us?
Now, I mean, I don't think.
Be able to do all those steps by ourselves.
Yeah. So homemade leverage. So I will not forget your question, Eva. I just have basically one slide left for today, and then I want to recap briefly and of course relate it to what's going to happen with this, what's next, and how that is exam relevant. All right?
Yeah.
Okay. So the conclusion, this is really our conclusion of today's class. Let me check the time. Perfect timing. We conclude. This is short for Modigliani and Miller. That's also the name of our lecture today in brackets and of the YouTube stream. That were two sophisticated scientists that started thinking about capital structure. What should it be? And we are now operating in a very simplified world. I've described a couple of aspects. Investors can borrow at the same interest rate as the firm. And most importantly, we are operating in a world with no taxes. When you go through the Excel sheet, you will immediately notice there are no corporate taxes anywhere, and there were no capital gains taxes on the investors either. So we are operating in a world completely free of taxes. So what we have just diagnosed is called Modigliani Miller Proposition 1. And yes, since it's called Proposition 1, you may safely assume I will have a second one and a third one for you at a later point in time. So this is called Modigliani Miller Proposition 1 in a world without taxes, no taxes. The important conclusion is the value of a levered firm equals the value of an unlevered firm. It should not matter if the firm is levered or unlevered. Shareholders can artificially undo any leverage or create any leverage that they want to see in the capital structure of the firm. So the value of the firm remains the same no matter what the firm does on the right side of the balance sheet. So the mix of debt to equity in a Modigliani Miller world with no taxes, it would be exactly the same. And this, the second blue bullet point here, that's simply the mathematical representation of the previous bullet point. Value levered equals value unlevered. Why can I state this? Well, because homemade leverage. Through homemade leverage, an individual investor, a potential shareholder, you, can either duplicate, in finance we would say basically replicate, or undo the effects of corporate leverage. So corporate means what's happening in the firm, regardless of what the firm decides to do, stay all equity or lever up, doesn't matter to you, the shareholder, because you can engage in homemade leverage, which means artificially create or undo any leverage that you see or want to see in the firm. That's it. That is it. That is what I have. Then, of course, I want to still address Eva's question. What does this mean? I mean, obviously, I have an interest that you understand this, but I also have an interest that you know a little bit what to expect on the exam. So obviously, Modigliani Miller will keep us busy for a while because of the didactic and intellectual approach that we are picking here when we talk about capital structure. We cannot immediately hop into capital structure as it is in the real world and come to meaningful conclusions. We, I think, need to build this up. So after I have shown you now today Modigliani Miller Proposition 1 in a world without taxes, we have to then say, "Naya, wait a second. This is not a science fiction universe. In the real world there are taxes, so we then need to slowly, bit by bit, drop our assumptions, for example the no tax assumption, and see if our conclusions change. So bit by bit, we will make this more lifelike, okay? What is relevant about this? So, well, the conclusions are obviously relevant. what is super relevant about this, Modigliani Miller proposition 1, the value of a levered firm equals the value of an unlevered firm in a Modigliani Miller world with no taxes. What's relevant for the exam specifically about the stuff we did today? Obviously, exam, homemade leverage. Homemade leverage. So I've shown you an example how you artificially can create leverage in your portfolio. Needless to say, you can also do the opposite. Imagine there is a levered firm, but you much rather hold the shares of this firm, the same firm, but unlevered. So how can you undo leverage, corporate leverage in your portfolio? So obviously there is more to discuss and there's more to calculate. And that is of course where the workshops come in, right? You know that Celine and me have designed the course, that workshops and lectures together form a comprehensive unit. This is the intellectual fundament. What is relevant about this? Well, for me, as your teacher and as a fellow human, it's relevant to me that you don't simply say, yeah, but he said that in class, so it's probably true. I hope that this calculation convinces you that I'm not just making crap up, but that we can logically derive certain inferences. There are reasons why we say value levered equals value unlevered. And the second thing is, I want that you go on Friday to the workshop because Celine and me, of course, spend a lot of time discussing which practical applications that you can do in the workshop are meaningful to complement the stuff that we discuss in class. So this Friday in the workshop, expect a lot of this, homemade leverage, okay? So that is where your attention should be in terms of exam. I will not ask you to basically, cook up an Excel sheet like this. No, but it could very well be that you get an example, something like there's a company, we get a couple of parameters, assets, equity, whatever, it has a certain capital structure, and then, lo and behold, somebody suggests a change in the capital structure, you are unhappy about it, and you're an investor, and you want to change it. Describe the homemade leverage that you would engage in. So that would be a very typical exam question, I would say. Guys, is there anything I can do? Any questions that have popped up? Anything?
So in our example, the homemade leverage was that the investor decided to borrow money from the bank, right? In this way, he created the leverage.
What's your question? So strategy B, yes, involved borrowing money, yes. But what's the question?
No, yeah, that was the question. How can we create a homemade leverage? So in the example, he did it using...
or she, yeah.
Or she, yeah, borrowing money from the bank, right?
Yes.
Okay, yeah, that's it.
Okay, now, okay, that's easy then to clear up, yes. So in this specific example, homemade leverage involved borrowing money on top of the funds that you had already available, yes. But really guys, don't forget this, right? So the lectures and the workshops don't exist independently of each other. So Celine and me, of course, we have designed this together to make sure that we cover everything. The intellectual fundament, the core logic, the mechanics of everything. And in the workshop, Celine will guide you through some extra scenarios, some a little bit more applied things. So I strongly recommend that you go to the workshop. I mean, the probability that you have homemade leverage in some way on your exam is, I mean, close to 100%, unless I will die before the exam, all right? Guys, any questions? Anything I need to recap? Anything I need to explain? Let me hop into the chat very briefly and see.
I also have a quick question, I think. It's just sort of also like a clear-up question. So, when looking at the first example, and also I think the second one, can I reasonably assume that the share price and those capital gains and the differences that is a full function, in our case, of equity?
The share price is a full function of equity, yes. This is a very cool point that you're raising. I think I showed this a little bit already. This would be, what you're describing here would be the sort of fundamental stock price. What is the fundamental stock price? Well, the value of all the equity divided by number of shares outstanding. That's basically the fundamental stock price, right? It's an actual metric that we can calculate based on the balance sheet. In the real world, very often stocks would be traded for more or less than this, depending on what shareholders think will happen in the future. But yes, in this case, you're absolutely right. The share price, that's why I stated book value and market value of the equity was whatever 8,000. That means we can really calculate then the price per share, the market price per share. Yeah, correct.
Yeah, thank you.
Guys, anything I need to explain? Anything unclear?
I have another question.
Shoot.
Again, it's for the trading strategies from the investor perspective. So you wanted to show that it doesn't matter for the investor whether to invest in a levered or unlevered fund.
Yeah.
But if I understood it correctly, the investor needs to, like, he spent double the amount for the unlevered firm to get to the same point than he spent for the levered firm, right? So basically, it makes a difference, right? Or
No,
not?
no, no, not right. Wrong. No, it doesn't.
Okay.
It doesn't because wait. Then I need to open the Excel sheet quickly. Hold on a sec. Let me close this here. Close. Yes. Whoop. Wait. Where is it? So. I just need my Excel sheet again. Where is it? Where's my Excel sheet? I don't know, I cannot easily open it quickly again. The logic was, you have the Excel sheet anyway, the logic was that we had the same amount of money available for both strategies. We started by saying, yeah, you have 2,000 euro in your pocket and you have to make sense of it. You have to create a trading strategy where the payoffs match in each scenario, levered and unlevered. In one scenario, we needed more money to build up a position large enough so that we ended up with the same earnings on our share package, on our portfolio, but that was simply by borrowing another 2,000. You're right, we spent in total more, 4,000, but the money that we had initially for both strategies was only 2,000. So that's why we had to borrow some extra, but that's irrelevant because the starting point was literally the same, 2,000 euro, 2,000 euro.
If I would have borrowed the 2,000 in the first strategy A as well, we would have come up with a higher earning per share, right?
Yeah, it would be, yeah, the numbers would, I mean, I have not done the math now, so the earnings would be different, that's what I'm willing to say, unless, I mean, I would have to calculate it now myself. But again, I already said before to Eva, the point of trading strategy A and B was not to show you, oh, with this strategy you can make more money. That's not the point at all. The point was, it doesn't matter if a firm is levered or unlevered, using the same amount of money, starting amount of money in your pocket, you can replicate the cash flows perfectly. Sometimes it involves borrowing money, sure, but the starting point was literally the same. You have 2,000 euro in your pocket, nothing else, right? So of course you can say, well, if this were the case, then you would have higher returns. That's all beside the point. This is not about maximizing profits here. It's about demonstrating that if there are no taxes and if you can borrow at the same amount, at the same interest rate as a corporation, and there are no transaction costs and all those assumptions, that for you as an investor, it should not matter if a firm is levered or not, because artificially you can create whatever leverage you desire. Okay, so forget about this. In the other scenario, you could have done something different to get a higher return. All true, but completely beside the point.
Okay, got it.
Super. All right, guys, let's stop here. Thanks for your good input, interesting questions. All the material is, of course, online. Don't be alarmed, I'm not going to upload a new PowerPoint slide set for tomorrow because there's still all kind of stuff that we have to figure out using this slide set. And the next lecture is tomorrow at 9 o'clock in the morning again. Please don't for a second think that I'm responsible for the scheduling. So that's not my fault. Guys, have a great day. I see you tomorrow at 9 in the morning in usual awesomeness.
Thank you very much. Bye-bye.
See you guys. Doei doei.